Hey, Terence.
Hello, Sachi. Hi, good evening.
Hey.
Great to see
Yeah,
you
good
again.
evening. Good evening indeed. It's really been a while since we've done one of this. I haven't been on in a while. I don't think you have either. So it's good to get back into the swing of things. And today we've got TunePro, which is actually a company that I'm personally quite keen on and have been following quite a bit. So I'm actually very excited about today's session.
Yes. So joining us this evening, we'll welcome the CEO of TunePro, Mr. Rohit Nambiar. Hello, Rohit.
Hi, guys. Good to
Hi,
see
good
you.
evening. Thank
Hi,
you so much
Terence.
for
Hi,
joining
Sachi.
us.
Thank you. My pleasure.
Yes.
Yeah.
So for tonight's session, we'll be talking a lot about the insurance industry, and Rohit has been very kind that he's willing to share a little bit about how to make sense of the financial numbers that's being reported, because as you know, the insurance industry's income statement and all that is slightly different compared to many other companies. So we are really grateful that Rohit is taking his time out of the evening to go through this with us as well.
Yeah, and actually, I think we were all pleasantly surprised to find out that actually Rohit was on BFM today morning. So it's been an exceptionally long day for Rohit. So really, thank you for taking the time today.
No problem. We love these kind of days. It means more people want to hear us, right? So that's the right thing to,
Yep, exactly.
get into.
All right. So maybe without any further ado, Rohit, we pass it over to you to start taking us through Insurance Simplified.
Yes, over to you.
Great.
Thank you.
Thank you so much. Okay, so for the listeners, I like to keep it nice and easy. So if you do have questions, keep popping them over in the screen next. We can go through them, subsequently. We can go through the answers. Today's presentation is going to be a little different. I'm going to almost take on a lecturer's hat. So I'll tell you a little secret. At some point in my life, I do want to get into teaching. Uh, Maybe because I was a terrible student myself. It's probably I'll make a good teacher, or at least that's what I think. So what we'll be doing is for the first probably 15-20 minutes, I'll be talking a little bit about basics of insurance. And then we will go into Tune Protect, and then we'll take Q&A. I'm mindful that insurance can be quite complex for a lot of people. There are many reasons why it can be complex, and we as insurers sometimes don't realize it, especially for someone like me who's been 20 years in insurance. It's very possible that I just forget how complex it is. The feedback that we often get is insurance is extremely complicated, complicated to buy, complicated to understand. Our policy wordings more often than not in the past was created with exclusions in mind more than inclusions. And I think also it's very complicated as an investor because of the amount of requirements around reserving, capital, etc., that we have to maintain. So, why do customers find insurance complicated? And what is insurance if you go to the basic of it? Let's try to understand that. Obviously, from our perspective, it's easy, but I think we make it complex. Essentially, insurance is very similar fundamentals to any organization from my perspective. There is sales, which is the revenue of the company. There is cost, which is the outlay of the company. Cost has two parts to it. There is the claims which we pay, which is when a customer claims when an unforeseen event happens, which is why we are here, and the cost to run the operations, to pay our distributors, etc., our employees, so on and so forth. Investments, which is obviously the income we make from the revenue, from the premiums we collect or the revenue we collect. We don't just keep it, we obviously invest some portions of it. And obviously there is a few other share of results, which is there could be organizations where we may not be in a controlling position, but we obviously get bottom line benefit from investing in them. We don't get the top line because you only consolidate top line when you control a business. Okay, and I will explain that as we go. um, Let me try to break sales down. This is something I love. You will see a lot of companies, um, according to their will and wish, use terms like GWP, NWP, NEP, and many times I hear investors, potential investors, come and tell me, "Are these three the same? Why do you say NWP is more important? Why does somebody else say GWP is more different to NWP, etc.?" The truth is, actually, NEP is the amount that we actually keep in that year, but GWP gives you a sense of the strength of the sales of the organization, and NWP gives you a sense of how much can that organization actually hold. Let me try to explain that without sounding very complicated. Um, in simple terms, very, very simple English, right? Let's assume a customer today downloads my mobile app or goes to my website and they buy a motorcycle insurance, or they buy a travel insurance, or they buy a motor insurance, home insurance, motor insurance, whatever it is. And let's assume that they want to buy a simple product, motorcycle, for 100 ringgit. So they pay the company 100 ringgit to buy it. That 100 ringgit is my sales, is my gross sales or my gross written premium. However, I do not keep the entire 100 ringgit sometimes. What do I mean by that? Insurers also have reinsurers backing us, which means, in simple terms for a layman, it's an insurer to an insurer. Okay? Because we also have to cover ourselves. What if all the claims come together? Can we take a huge claim in a particular book? This kind of stuff we have to be aware of. So, what we do is risk transfer. We don't transfer everything. For example, in Tune Protect, for travel insurance, we keep 100% of our risk because we think we know the business very well. Our balance sheet can handle this risk, and we don't see a reason why we should transfer it to another reinsurer outside the group. However, when it comes to, say, SME, there are some products like SME engineering where we may actually only keep, say, 60%. Why do we keep 60%? Because we believe from a risk perspective, we shouldn't keep 100% from, based on the actuarial analysis, and we should pass on 40% of that risk. So when a claim happens, our claim is limited to a certain amount beyond which the reinsurer kicks in. Now, in simple terms, in this case, for example, we are assuming that 30 ringgit is transferred to a reinsurer. We are only keeping 70 ringgit. So actually, net written premium is essentially the premium that we actually keep with us as a company, for which we are accountable for claims. The remaining portion of that claim has been passed on to a reinsurer, even though we will still be the one paying the claim to the customer. That portion we will get it from a reinsurer if that event happens. Now, let me try to explain that into how that results in NEP. This slide sounds a bit complex, but let me try to give it to you in very simple terms. From my perspective, NEP is the premium that you keep in that year. Why is that? Because there are certain portions of the premium which are not for this year. It could be for next year. As an example, if the motorcycle policy was bought on July 1st, actually the premium is only for 6 months because the remaining 6 months is for next year. So I can't take credit for the entire 100 ringgit even under earned premium, neither. And if it is being reserved, which means 30% has already gone to a reinsurer and I'm keeping 70, then I can't pass on the whole amount for the year. I have to apportion half of it to next year. So what we do is, when we get the 70 ringgit, which is the actual premium we have, because the 30 ringgit has gone to the reinsurer, what we will do is we will immediately reserve roughly. Yeah, normally there's a formula for this, but in simple terms, let's say I reserve half of it. So I reserve half of it, which is basically for potential claims. I will take the remaining amount as my earned premium, and then I will keep earning the premium over the year, assuming it's a full year policy. If it's not a full year policy, I will not earn the full amount, which is why you will always see GWP is a big number, NWP is a smaller number, and NEP is a much smaller number, unless and until the company has consistent sales flowing through over several years, which means there's always a flow through from previous year, flow through to the next year, and so on and so forth. Um, this is very important that you understand the revenue side. I will repeat from my perspective. GWP shows you the strength of the sales of the company. NWP shows you the actual premium that an organization is going to be accountable for. So many times, I personally look at expenses over NWP, although other people do look at expenses over NEP, because expenses in that year versus the earned premium of that year. But the reason I look at written premium is it gives me a sense of how much is this company spending to get the premium they are going to keep, whether it's this year or next year. But there's always two ways of looking at it. And NEP is the premium you keep in that year for that year's expenses. Generally, we say your expense should not grow faster than your premiums unless it's years of investment, etc. When your premium is growing faster than your expenses, you're obviously improving as an organization. Now, cost, like every company, we have costs. Broadly speaking, there are three broad buckets. Of course, those expenses can be broken down into even further ones. Accountants would always tell you there's fixed expenses, there's variable expenses, there's so many other expenses. But in simple terms, expenses can be broken down into commission. Commission is the amount I pay to a distributor to get the business. Claims is basically me honoring the promise I've made to the customer. So it's the amount that I will be paying out when the claim comes in. And management expenses are all the expenses required to run an organization. Now, management expense can be staff cost, management expense can be IT cost, management expense can be office costs, management expense can be branding costs, it can be all of that. Now, the way, as I was saying, is in never should you look at is expense increasing. I always see comments that TunePro's expense increased. No, you should look at it as whether the expense is increasing commensurate with the premium growth. If the expense is increasing slower than the earned premium, then you are making more money for sure, unless your claims gets worse. And that is why it's important for your expense ratio to improve, not necessarily your expense should reduce. You look at this example, the management expense has increased in the case of the company we are showing here. The commission has increased. Commission has also increased. But you are seeing the expense ratio has improved because naturally the premium here has grown faster than the 19% increase in expense. So commission ratio is nothing but commission divided by premium. If a company's commission ratio is increasing, you should always ask why. Is the commission ratio increasing in a business where the claims ratio is lower? Then it makes sense. If the commission ratio is increasing in a business where the claims ratio is also higher, it doesn't make sense, because then you're essentially paying out on both sides. How does a company earn insurance profits? Insurance profit is nothing but, it's also called underwriting profit or underwriting margin or combined ratio. Let me explain that in very simple terms. Combined ratio is it's also called combined operating ratio by certain people. Combined ratio is nothing but, your denominator is your premium and your numerator is all the outlay, which is commission, claims, management expenses. So let's assume if you earned 100 ringgit premium in a year, you spend 40 ringgit on management expense, you spend 20 ringgit on commission, and your claim was 35 ringgit. So it's 40 plus 20 plus 35, means it's 95 over 100, which means this company's combined ratio was 95%, which means they made an underwriting margin of 5 ringgit, which essentially is very good for the company. Oh, sorry, 5%, which if I were to convert in 100, it's 5 ringgit is the underwriting margin, and that shows the insurance profit. Now, it's the same thing if I turn around and I say this company's commission was 20 ringgit, their expense was 60 ringgit, and their claims was, say, 50 ringgit. In this case, it's 60 plus 50 plus 20, it's 130 over 100, which means their combined ratio was 130%, which means their margin was minus 30%, which means their underwriting profit was minus 30. That's why combined ratio is very important, and also looking at sub ratios like expense over premium, claims over premium, and commission over premium gives you a sense of the quality of the business. Every insurance business has different signatures. In the case of Tune, because we have a sizable chunk of travel and PA kind of business, our claims ratio tends to be much better than the industry average. But our commission ratio will be higher. Why? Because even regulatorily, travel, you can pay a higher commission in Malaysia and it's controlled by the regulatory cap, 25%. For motor, it's 10%. For PA also, it's 25. For motor, it's 10%. So a company which has higher motor mix among your listed companies will have a claims ratio which is worse than us, because motor claims ratios are worse, but their commission ratio will be better than us. So there are nuances. Overall, always look at combined ratio. Is combined ratio getting to 100 and below, and how much below 100 it is, shows you the strength of the company. Because I always say, as an insurance CEO, sorry, my responsibility is to manage the insurance profit of the company. The investment is second, importance, and I'll come to that. So in summary, there are three kinds of situation, and if you are below 100% on combined ratio, you're making a profit. If you are 100%, it's a break even on insurance. If it's above 100%, it's a loss. This doesn't mean company is making a profit or loss still. Why? Because I invest the revenue I make in the market, and I'll come back to that. It's important also to understand there's always a timing mismatch between sales and cost, which always makes it very difficult for new age investors to understand where and how to manage businesses. What do I mean by that? Sounds a bit complex, right? Some costs are apportioned over multiple periods. Some premiums, as I explained to you, is not all for this year. You have to apportion it for the risk period. So there is a certain timing difference that always happens on underwriting profit. So in this case, you look at it. Let's bring back the same case together. 100 ringgit was my GWP. I transferred 30 ringgit to reinsurer, which means my sales is 70 ringgit NWP. Now, NEP, I'm earning 34, 12, 12, 12. Remember, I reserved 36. in the first, and then I earn it back. My commission was 20%, so I paid 20 ringgit, and the commission I straight away pay. Okay, because annual policies in GI, we don't have many monthly policies in GI, so it's normally annual. My management expense ratio, I account for it. My claims is paid over a period of time. So do you see my insurance business suddenly with the same 100 ringgit, which I got in first quarter, I made a 1 ringgit loss in first quarter. And then I start making 10 ringgit profit. Why is that? In simple terms, that's called new business strain, which means always in insurance, it takes time for profits to come through because there's always expenses, claims, and reserving, which you have to account for in the beginning before you start earning something from it. Obviously, in this case, if the claim had gone worse, in the next few quarters, obviously that 10 ringgit may not be what it is. Okay. So I always tell people, do not look at insurance as an immediate business. When we were signing up partners after partners, I used to educate the market saying, you are not looking at our business properly. You think I signed 10 partners, next quarter I'm going to get business. I'm getting business. But this is what is happening. It's flowing through, which is why in insurance, if anybody sells you a 1 year story, you got to be very careful. It's very easy in general insurance to make short term profits. You can play around with expenses, which means you can cut down your expenses, which is not good for the strength of the company for the future. You can make more aggressive assumptions on reserving, but they will come to bite you because the regulator will come behind it, auditors will come in, and your own actuaries won't be comfortable. So in insurance, you have to be patient, and you also have to understand the signatures. Okay. I'm conscious I'm not reading the questions, but I would say just give me some time so that my uh, you know the thinking just goes through, and we'll come back to it. Investments, as I told you, I don't just keep my premium, I invest it, right? So my investment income um, has few components. I invest in bonds. I invest, well, you can potentially invest in many assets. It is driven by what is called a strategic asset allocation. There is an asset allocation mix that is approved by the board. There are certain regulatory requirements in each country. Many regulators do not allow you to invest beyond a certain percentage in higher risk assets like equity, etc. Some regulators don't allow you to invest in private equity or REITs or cryptos for sure. um, some regulators allow you to risk with a certain small portion, so it depends. In the different jurisdictions the rules vary. um, so in our case we only have exposure to money market, bond, and equity is only 2% today. So our investment income has two lines: realized gains and losses, and fair value gains and losses, or unrealized gains and losses. Fair value gains can also be called unrealized. Today, our investment is approximately 700 million, 683 million to be precise. If you look at our investment income, as you see, we with the equity, bond, and the money market, we make interest and we get dividends, right? Now that's the investment income. But there's actually also realized gains. Realized gains are basically that already have been sold and converted into cash. We've actually realized the benefits. Now, this is where it gets tricky because it's accounting mumbo jumbo. I'm from a finance background, so I can blame myself for it, for being part of that community. There is a huge portion of unrealized. Unrealized is basically when the investments move up and down based on the current market value. Accordingly, we have to book in every month and unrealized. It is not realized. It doesn't mean I have sold at a lower market value. I haven't, but I still have to show the lower market value. Similarly, if the market value goes up, I still have to show a unrealized market value gain, even though again I haven't sold and actually made the gain. So there is an unrealized portion which many call paper gains or paper losses, which means I haven't realized it. But if I were to realize it today, this is the profit that it would make, or this is the loss it would make. So, in simple terms, right? The same thing if I were to explain. If our stock investment value were to increase by 20%, say from 10 million to 12 million, if we sold the investment, I make 2 million as my realized gain, subject to each regulatory and market landscape, their tax considerations, but let's leave that aside for a minute. If we retain the investment in our books and we don't sell it, it's a 2 million realized gain. Okay, unrealized gain. Sorry. So I haven't realized it as yet. So the other element is, we do have associates. So we have 49% in our Thailand business. We have 49% in our EMEA business. They're called JVs or associates. Here, we only consolidate them at the bottom line level. Do you know today your top line of the group does not include these two companies? Um, because they are associates. They go through the bottom line of the company. So what that means is their profit or loss goes through to the bottom line of the company for the portion which we own. So if they make 100 ringgit profit, I take 49% of it. If they make 100 ringgit loss, I take 49% of it. So let me simplify the statement for you, and I'll take a couple of minutes here. Gross written premiums are basically the sales of the organization. Net written premium is the actual revenue that I keep in the organization. And net earned premium is the premium I keep for that given year. Simple English, Actuaries make it a little bit more complex. Finance people make it a bit more complex. But in simple terms, that's what it is. Cost, you have three types of cost. Now, the cost, in simple terms, if your sales is bigger than your outlay, which is cost and claims, you're making a profit. So if your premium is more than your commission, claims, and your expenses, you make an underwriting profit. If your premium is lower than your commission, claims, and expenses, you make an underwriting loss. Always look at this line, which is why TuneProtect is telling you that our aim is to become positive on underwriting profit this year. Why? Because that gives you confidence that the core business is strong enough. Investment, we are not there today, but that's our aim to get there. Investment income is the income I earn from investing some portion of my premium in different assets. And that is the realized gain is when I actually I sell or I realize the gain or the loss on an instrument. Unrealized or fair value gain or loss is when I may have a loss or a notional loss or a paper loss or paper profit, but I haven't realized it, which means I actually haven't really made it, but I have to report it still. And share of results of associate or JV are companies where I only take the impact straight into my profits. Okay, so in simple terms, profit after tax is a function of underwriting or core insurance profit, investment income plus share of results of my JVs. From a ratio perspective, commission over premium, claims over premium, expense over premium gives you those three ratios. It tells you whether a company is improving on those ratios, but combined ratio essentially gives you a sense of the underwriting margin or the profitability of a company. If you look at our own organization, combined ratio is one of the 5 quantitative KPIs on which all of us are measured because it's the most important KPI. So always, as I said before, look at different layers, see whether the ratio is improving, not absolute amounts. A question I'm often asked is, what is the difference between a traditional insurer and an insurtech? Actually, I will have to go down a little bit of a story. I have written a blog on this and an article on this, which is available on our TunePro socials. You can always read up on it. Um, See, traditional insurers, especially in Asia, if you look at it over the last, say, 20, 30 years, have had very high growth rates. Why did they have high growth rates? Because their focus was primarily on high and medium net worth individuals. Traditional models of distribution worked very well because these were big ticket sizes. You needed the relationship. Digital and technology was not so advanced. And obviously, big ticket size, you can afford traditional models of distribution as well. But today, there's a whole new segment of customer, Gen Z, millennials, etc., for whom they are underinsured, and typically they are mass market. There are some exceptions, of course, and for them, the traditional models of distribution may be difficult because your premium sizes are much lower, and their way they consume, because they're used to Lazada and Shoppees of the world, the way they consume the products are also very different. For that reason, um, it's important to speak to them using digital partnerships. Insurtechs, in simple terms for me, are people who make customer experience simpler. Some insurtechs go into niche areas like fraud flags, better claims handling. They're also aggregators. But insurtech is never only a website which sells insurance policies. Let me make that very clear. Initially, insurtechs and insurers always thought we didn't trust each other. Insurers thought insurtechs are going to take my market share away. Insurtechs, we always had this feeling that, oh, we're just going to take the business away from the traditional guys. Actually, neither happened. Traditional insurers still remain very strong. And insurtechs also realize that if we don't work with them, we're not going to make it. And traditional insurers who tried different ideas like, okay, let me put the youngest guy in the room to become a chief transformation officer or a chief digital officer. And I've said this joke many a times, why don't you have a chief electricity officer? Digital is like electricity. Why would you want a chief digital officer? The same way, there's no reason, it just didn't work. These ideas of appointing the youngest, smartest guy in the room as a chief transformation officer, or uh, setting up an innovation lab for it doesn't work, because if you're too traditional and you're too risk averse, it's just not going to work. And similarly for insurtechs, they simply didn't have the scale, and it didn't work either. Which is why in the last few years you're seeing insurtechs and insurers work together a lot more. And this is where we are seeing a lot better disruption. There is a lot more understanding of certain areas. I'm far better than you in certain areas. You're far better than me. So let's work together. So I think I would say broadly you should look at it from three perspectives. The first one is products which are bite size, and traditional insurers don't have the tech because of legacy, or it's just too small for them to disrupt, so they don't want to do it. So they will, the insurtechs are better placed over there. Where insurtechs also come in is where they're able to disrupt niche space within value chains. And I do believe that there will be more innovation as we now finally are getting a better hang of data and how to use data. And we all know data is the next oil, if it's not already the next oil. Okay. Now I'll come to the 8 commitments that TuneProtect made for 2023. This was made way back in 2020 December, 2021 January. I always said I do not manage quarterly results. So I don't get disappointed or I don't get excited when the quarterly result is good or bad. I am sorry. That's just the way I run business. I do not manage quarterly results. If the day I start managing quarterly results, I should not be a CEO. I should be a trader. I'm here to run the business strategically. So all stakeholders see long term value being created, which is sustainable. Yes, it brings short term pain with that, but I think that's far better than creating long term pain. We gave 8 commitments to the market. The first one was we want to retain 70% of our business and we want to grow at 25 to 33%. And I will come to why that's important. Our retention ratio has improved from 49% in 2021. In fact, it's even lower earlier to 62% in 2022. Why is this important? Do you remember the GWP, NWP, and NEP? It is very important to retain more, which means I can pass more expenses, which means I can make more profits. Which is why for us, retention ratio is quite an important KPI as an insurer because I am not a broker. I'm not here to pass business to someone else. And obviously, I don't want to do high risk business. So, which is why retention ratio becomes very important. And the 3 lines of business which I'm focusing on, health, lifestyle, SME, are businesses where I retain more and I'm more comfortable. And I announced that I will exit large commercial. I can't insure oil rigs which are 1 billion in investment, right? Sorry, 1 billion in 1 billion in sum assured. It doesn't make any sense, right? My NWP, I said I want to grow between 25 to 33%. Last year, I grew 72%. It's very important to look at this in reference. We had an issue. Before 2021, we were declining for 4 years on NWP. And I told you NWP tells you the strength of the company, right? Of what business I can keep. And that is why we had an expense problem because we were not retaining enough. Once we retain more, we can invest more, we can make more profits eventually. So you're seeing our NWP is the highest since it listed. And we're also seeing that it is constantly moving, which will help us as an organization. So from a 3-year CAGR of 25 to 32%, and from a retention target, you can see both are going the right direction. We also have a lot of this growth thanks to digital partnerships. Many people ask me, what is insurtech? I always say it is what makes the customer experience easy. For me, I don't need to sell on my website alone. I'm happy to sell through any distributor who can get to my customer in the most efficient digital manner. From 15 digital partners in 2020, before that 5, to almost 75 as we speak, my digital partnership has gone up significantly. As you can see, the digital partnership business has gone from 55 to 154.5 million. It's coming from multiple countries. You've seen the Vietnam growth as well. We're bringing it from different parts, not just Thailand, Malaysia, Middle East, but it's also countries like Vietnam. And this is critical. Why do these digital partners work with us? I have a simple view. Nobody can execute faster than me. And that's the beauty of the tech I have, which is why I also talk about making my tech business a separate business at some point. We want to have a more efficient organization on a ratio basis. What do I mean by this? We talked about combined ratio. Our combined ratio last year deteriorated. But again, it's important to contextualize it. Why did it deteriorate? It deteriorated because we had the highest top line growth. And if you remember, I talked about timing of premium. So what happened was the premium was earned over 12 months, but all the commission and expense hits me immediately. So let's assume I made 100 ringgit premium, 30 ringgit commission I straight away booked, but I only earned 8.5 ringgit. So the first 3-4 months you can see it's 8.5, 17, 25, 33, and your expense is still 30. So you earn the premium over 12 months. That's why you saw the combined ratio improving as the year progressed, because the high growth in the short term created the strain that I talked about earlier. But obviously, this is something we plan to resurrect, and you can see our expense ratios have improved as well. Obviously, as I mentioned before, we want to evolve our tech business. Our tech business is our differentiator. I've spoken in different conversations, um, about the fact that our tech business is now no more just about TunePro. Today, we have 3 paying clients. We expect to have a few more in the months to come. Um, for our tech business, I think the key is it's a very important differentiator for us because they really help us to execute faster. When I go for an RFP, I say nobody can execute faster than me, and that's my differentiator. The tech business has an API platform. There are insurtechs like Cover Genius, who you would have heard is a multi-million-dollar insurtech, significant valuation more than us. They did about 11 million policies, and it was a big news. Actually, your Malaysian company today, we do 11.1 million policies on our system. Unfortunately, we are not spoken about enough. Even today, I read a post on LinkedIn where someone talked about Lemonade, and someone talked about Sing Life, and someone talked about a few other companies. And I said, all the things you mentioned here about digital partnerships, technology capability, API, AI, customer satisfaction, I have it, but we are just unknown. And that's why we need to do a better story to explain to the people that we are coming. We haven't arrived, I don't deny that, but we are coming. Lemonade hasn't arrived either. Lemonade is a startup that is making losses, even though they've been in business for a few years. They are multi-billion-dollar valuation, for very similar reasons as us. And you can see what our valuation is. We want to grow our ASEAN presence. Vietnam has grown pretty interestingly last year for us. We work today with the second largest e-hailing company. We work with a very large e-commerce company. We work with the largest payment gateway. We already signed up much earlier. We were working with the largest e-wallet company. We are working with Bamboo Airways. So we continue to work on new partners, and it's continued to be a growth business for us. So we're not just a Malaysian Thai company. Middle East has grown for us, and Vietnam is growing for us. Mobile is quite important for us. We have 13 products. We have a health tech app, so you can track your steps, you can track your sleep, you can track several data points there. And also, you can do pay as you drive, you can buy, you can service, you can claim from us on the app, and several other things. I'm not going to go into all those details. We give a lot of importance to what's called Net Promoter Score. It's one of the 5 KPIs of all the management staff, right from me to every new joinee in the company. 15% of the bonus is influenced by the customer satisfaction of the company. What do I mean by that? Is Net Promoter Score is nothing but, when you go to Changi Airport in the toilet, you have a Net Promoter Score. Happy, not happy. You see that in many other places. Promoters are those who rate us between 10 and 9. It means they are ready to tell their friends and family to buy from us. Ultimate truth of customer satisfaction is that. Detractors are between 0 to 6. They are the people who don't like us and won't recommend us. 7 and 8 are fence sitters, and we don't even count them. So NPS is nothing but promoter minus detractor. The more percentage of promoters you have, obviously your company is in a better space, which means more people are going to speak about it, better word of mouth, better conversion, etc. Our Net Promoter Score was minus 16% when we first did the baseline in early 2021. It's now at plus 39% and one of the best in the markets we operate in, if not the best. And versus the companies we benchmark against, I don't want to name them here. You should know who these players are, top players, but do have a digital presence. Our NPS is much better. A simple example, Lemonade never tells the market, I want to be number 1 in market share, because they can never be number 1 in market share, at least in this lifetime. Because the largest insurance companies in US are 100x their size. What they say is they want to be number 1 in their preferred segments, and they want to be number 1 in customer satisfaction. Why? Because that brings better word of mouth, and that brings better traction in their specific lines of business. Lemonade, the glorified insurtech, is only present today in home, life protection, and pet. They've just launched motor by way of an acquisition of Metro Mile. We have 13 products today. Employees, very important. We are really focusing on being an employer of choice for millennials and Gen Z. Much younger. We have, we're quite a fun company to work in. We have a culture which is called fun and uncomfortable. Um, our HR head Sui and team have done a remarkable work. We were minus 26. I would say many insurers are, and we moved to plus 26, and we continue to attract a lot more younger people. We continue to attract a lot more internships who convert into permanent hires. So obviously, younger people, younger customer, it all makes sense, right? Sustainability very important, because I think the people of today feel, anyways, we've given them a worse generation than before. We are the only insurer on FTSE for good. That's an index that is designed to measure companies' ESG efforts and initiatives. Um, why is it important? I think sustainability is very, very important. For the younger generation, it's not a nice to have, it's a must have. For maybe the older generations, it was a nice to have earlier. Um, and you will notice that within ESG, we are the only insurer in the FTSE for good index. Our score has been improving regularly. We are a zero paper organization. We have gender commitments. 50% of our leadership will be women. 50% of our leadership will come from within. Actually, in the past, what happened was new CEO, new CFO, new CTO, new everything from outside. That's not sustainable. And that's why we have a target where 50% of our critical staff will come from within. And I'm happy to tell you that in the last 5 senior appointments, 4 have come from within, including the chief operating officer, including the chief governance officer, including the principal officer for TPL. All have come from within, which tells you, where we are growing the business. We've also announced we'll be exiting coal, underwriting coal by 2030. So there's a host of things we're doing so that the customers really see us as someone who's sustainable. It is very, very important as an organization. I will stop there, and I will take questions you may have.
All right. Thanks a lot, Rohit. I think very helpful, even for me, just to understand the financial side of insurance businesses. I think it's safe to say that it's really very unintuitive for most people to understand how the numbers work. And so I thought you just going through that was actually very helpful. And also, thanks for all the audience questions that have come in. But Rohit, I was thinking before we jump into the audience questions.
Mhm.
Oh, sorry. I just saw a chat from April. No, anyway. Um, I was just saying before we jump into the audience questions, I was actually we've got a couple of questions on our site as well, and maybe we'll just start with those, and then
Sure.
we'll build in the audience questions as we go through the flow.
Mhm.
Um, I noticed that in January you got approved to get into the B&M sandbox for life and health insurance. Do you mind just talking a little bit about that and how that fits into your overall strategy, and what does that actually mean for TunePro?
So, what does a sandbox do? A sandbox is not a full application. Basically, the regulator is a very interesting initiative from Bank Negara, which we like. It allows you to test an initiative before you, look at it as a full insurance company. So in our case, we want to test a life business model. We believe for our Gen Z and millennial and SME customers, there is a proposition out there to do a sandbox and disrupt the business. So it's not a full license, it's for a fixed period of time when we have to prove ourselves and prove the KPIs for Bank Nigara as well as us to see how we can graduate from it. It gives us a good chance before a DTO application process starts to test whether there's a viable digital life insurance model for us.
Okay, and thanks for touching on Ditto. That's actually my next question. Do you just mind educating the audience a little bit on what Ditto actually is, and since TunePro is already, I would say, a digital first insurance platform, do you actually need the digital license?
Good question. So, what is DITO? DITO is basically digital insurer and takaful operators. Bank Nigara, like the digital bank process, has announced that first they release a consulting paper. Now they've announced the exposure draft. The industry can give feedback by the end of April. By the end of December, they expect to issue the formal draft inviting applications. The expectation is we'll be given 6 months time to respond, and from there they will, after a few months, announce who's the winner, which probably should be by the end of next year or Q1 of year after, I'm assuming. And the winning part, they're expected to give 5 licenses, is what I hear. And similar to digital banks, then they are given a period of time to establish a company to do digital insurance. Your capital is expected to be lower than a typical company. Normally it's 100 million. It's expected to be 40 million to start with. But again, this is still in a consulting stage, as you know. In our case, for digital general insurance, we don't need it. We are already digital. You can buy, sell, claim from us. But how the life business graduates, we are still evaluating whether a DITO license or other options are the best way for it to graduate.
Okay, got it. Terence, maybe I pass it over to you.
All right, thank you. Yeah, Rohit, actually, I just wanted to ask a little bit about the Pump app that you have recently launched. To my understanding, there was a launching and all that. How has the reception been so far, actually?
Very good. I think we are starting. You'll see us a lot more. It was launched only in late December. In fact, I think around 20th, 25th of December. So I think January went in just stabilizing it. Um, Yeah, so I can answer that question. So on the Pump app, we are starting to see a lot more attraction. We're starting to be in a lot of events. We sponsored the YOLO Run. We are at the triathlon. We're at different events, and we're starting to see a lot more interest from fitness-focused people. Yes, if you download and use our Pump app, it's not a Pump app. It's actually a Pump is a feature within our Tune Protect mobile app. It's not a different app. um, because pump app doesn't sound good. So pump is basically the pump you get from the gym, within the Tune Protect mobile app. You do get benefits. You get benefits like things like as simple as free coffee, to discount vouchers, for sleeping better, for walking more, so on and so forth. We actually have a slightly different view on how we look at this. We don't think a customer today, especially Gen Z, are ready to wait for 1 year later, I give you so much discount. It's an instant gratification generation. It's a generation of e-commerce where vouchers are available dime a dozen. So we do think it has to be much more instant, which is why we look at smaller initiatives than much longer term initiatives to drive healthy behavior.
Okay, understood. Thanks for answering this question. I hope that answers your question. Yeah, our latte journey, very interesting name. While we're on this digital topic, the topic of cybersecurity has, entered the headlines many times, and this person has also asked a question. Can I insure against
Yes,
cybersecurity
you
and
can.
scams?
Yes, you can. For now, we are partnering with a company called Senang. So if you go online and you hit set up Senang, you can with us. We do have a cybersecurity and scam policy, which is as cheap as 145 ringgit a year, which is less than little more than 12 ringgit a month. We cover you up to 10,000. Sum assured for online phishing scams, etc.
It's
and
really
and
understood.
the more I speak to Gen Z, I was at Harriet Watt University 2 weeks back, and I asked some of the students saying, what is insurance to you and what really matters to you, right? Obviously the first one was travel insurance. They all love to travel, so travel is definitely top of the mind. It may also be because they look at me and they think I'm a travel insurer, which I'm not, but it's okay, good to hear that. um, I'm not just a travel insurer. The second one they say is cyber security. They are concerned about cyber. The third one is device protection because Gen Z don't want to own house, don't want to own a car. For them, device is their biggest asset. So device protection is important. The other one they talk about is products like social media insurance, which is what if my followers are lost? What if somebody hacks my account? Gaming insurance. So insurance out there is changing very fast as well. I don't even know 20 years from now if the motor insurance will be anything like it is today. So I think cyber is quite important in today's world, no question about it.
Will TunePro look to develop further in this kind of, I would say, quite niche insurance offerings at this?
No, very much. But we won't do commercial cyber. So we won't insure large companies against cyber exposure. That's not our expertise. But within the individual and SME space, we will continue to look at new areas to help companies for sure.
So if I use your TunePro app, I can just add on this kind of like
Not
cybersecurity
yet,
rider.
not
Okay.
yet. We haven't given it direct to consumer for the reason that we are still testing first with a partner to see if there's a business case to sell it direct to the consumer. Sometimes we launch certain products direct to consumer. Sometimes we launch it to a digital partner to see whether there is scale before we launch this, because we also think there's a little bit of education required on this product. So it's a journey we have to go through, but why not? If the feedback is there, I'm happy to put it on my mobile app. That's probably the least of my worries.
Okay. One more from me before I pass it back to you, yeah, Sachi. I just wanted to pick this question from the floor. Lin Chin Ang was asking, does TunePro plan to introduce insurance products in collaboration with e-commerce?
We already have it. I can't name the company, but actually one of the larger e-commerce companies in Southeast Asia sells consignment insurance with us, which means if your good doesn't reach the customer or if it is damaged, we cover it, and it's at a percentage. So we work with several e-commerce companies already. We work with Shopee in Vietnam and Bao Viet to sell home insurance. So there's a few partnerships already within the e-commerce space. A good, I would say probably at least 10 of the 75 partners are within this space.
Okay, good to hear that. All right, hope that answers your question. Sachi, over to you.
Yeah. Sorry, Rohit, just picking up on what you mentioned. Did I hear you correct? You said home insurance.
Yeah.
So just
In
out of curiosity, because my understanding of insurance is, at least in the way it was more traditionally done, the whole idea is an agent meets you, understands all your profile as a customer, and they then evaluate your risk, and you get basically given a price for a policy, right? If you're doing this online, how do you actually uh, meaningfully assess the risk of a customer in the case of selling home insurance online?
So actually, what happens in our, you can go and buy home insurance from my website today, right?
Yeah.
But the whole idea of this is, I think there are two kinds of customers. One who's buying complex products, much more value, much more emotion at stake. They definitely need advice. There's the other group of customer who wants to make their own choice. So we make it as simple as possible. You can actually go online and buy the most basic home product from us, and then you can click and buy as many features as you want, and you can buy, and we explain the feature. You can click on it, you can see what it is before you buy. So it's like buying a budget airline ticket today. You can buy as simple as you want, but you can add a fancy seat, you can add food, and you can make it as complex as you want it to be. So from our perspective, we are simplifying the product. Why is home insurance complex? It's because I put everything into it. It is complex. If I tell you I'm only covering your building, or I'm only covering your building, it's not that complex. Then if I say, oh, you want to cover contents, you want to cover digital contents, you want to cover against flood, you want to cover against etc. Then you can click buy. Makes it a lot more easier.
Okay, understand. Then so I guess we're now talking about how insurtech kind of like fits within the landscape, allowing you to basically it almost becomes an a la carte menu, right? Before this, you were basically given
Yes.
like package deals with very little
Yes.
flexibility, but I I guess insurtech comes in and because distribution is a lot cheaper, a lot easier, it becomes almost like an a la carte menu where you don't need to bundle it together. Is that a fair way of putting it?
Spot on. For us, we call it bite size for that reason. In the
Okay.
traditional world, because of things like legacy system,
Mm.
you just cannot do these bite size products. There's actually products you can go and buy. You can buy my PA for even 1 day.
Okay.
You can buy a travel insurance for 1 day. you know again, today with big pay, do you know I pay your claim? Actually, if you buy my flight delay insurance and you are a big pay customer, you don't need to claim with me. I will auto pay to your big pay because I will get the data. I'll match the PNR and I will pay you the claim. I have paid, since I've launched this, I've already paid 100 plus claims without the customer even claiming. I already do that in Vietnam. I already do that in Middle East. So that's the beauty of InsurTech. It's very simple. I just need customer consent. I need to know which flight they're using. My tech and data team will match the data dump of the PNR number versus the flight that they were originally supposed to. If that customer's flight has been delayed, pop, you get the big pay card gets credited with the amount.
Okay, that's very seamless and very modern. I mean, for me, I'm someone who's very tech centric, very tech oriented, and my general view of the insurance space is that it's still very old school, for lack of a better word, right?
So
Um,
I'll also tell you, right? This is where, sorry, I cut you off. Actually, this is where it also, insurance, I know why it's complex also because I've been there. I'll give you this example, right? Where we are paying parametric claim. We did that with a airline, with a e-wallet company in Vietnam first. We never did it in large scale. We normally first test such innovations. We have a concept in the group called you do, I see, I observe, which means Malaysia is executing an idea first, means they do. Thailand sees means they're executing next, and EMEA observes means you're third in line. That's how CI was implemented. That's how Home was implemented first in Malaysia. CI was first implemented in Thailand. COVID travel was first implemented in EMEA, and all the others have copied each of these products.
mm,
Why do I give this example? In the case of parametric claim, we first launched in Vietnam because it's much smaller size. What we found was the claims is significantly higher because several customers do not claim when it's a very low value. Even though they pay a premium, they don't claim, right? So
okay.
when it is automatic, your claims free incidence tends to be higher. So what we said is, okay, you want instant claim, you now have to either pay for it additional, so it's a benefit, or you're going to accept a lower claim amount. Which one do you like as a customer? So in different countries, based on legal jurisdictions, we offer it as a benefit. So in Malaysia, it's a benefit. I can't give it to you in my standard product because then my claims is just going to go completely out of whack. So this is where, as you make it more comfortable for the customer, there's obviously a price to it.
Okay, thanks for that, Rohit. Very, very thorough, and I think gives a very good context to everyone about, I guess, to an extent, how this evolution is happening. Uh, maybe just taking that train of conversation one step further, right? How do you see insurtech disrupting the traditional legacy agent model that's been out there for the longest time?
So I again, there is a blog I've written on this on agency 2.0 and insurtech, and happy Sachi, depending on how you like to share information with your audience, I can get Afrol to set some of these different write-ups we have from time to time. Just coming back on this question, right? As I said, insurtech has disrupted insurance industry in specific segments. For example, there's an insurtech called Shift, and I'm not promoting any specific insurtech. I'm just giving a few names here and there. Yeah? There's
Yeah,
an
sure.
insurtech called Shift who has gone deep on fraud analytics and fraud flags. So basically, they give you a framework where the minute I run my data through this framework, it will tell me which claims are clear, just pay. Close your eyes and pay. Which claims are likely fraud, which claims need probably further questioning. And over a period of time, they fine tune the model, fine tune the model, fine tune the model. So if you look at successful insurtechs, these are players who found spaces where they believe they can do a better job than traditional insurers who have 100 things to do. However, insurtechs also have become aggregators. No problem. There are some aggregators as well. On the agency side, you look at mature markets like US or UK. Agents haven't died. In fact, agents have increased their value over a period of time, which is why I say there will be an agency 2.0 model. What do I mean by agency 2.0 model? In this model, you look at UK. Within 2003 to 2005 in UK, motor, travel, home completely switched from agents and brokers to aggregators. I can almost tell you, if you ask me, this switch will happen in Southeast Asia for sure. Low involvement products like motor, home, pet, travel is going to go to disintermediated channels. Intermediated channels are going to have a very small portion, which is purely relationship, my brother, your sister kind of relationship. The others are going to go digital. However, and this is a fact that I tell even my distributors, I tell any agent I meet, and I say, you will still remain very relevant. Focus on the right segment. The right segment is segment which requires advice. Today, when I still buy a life product, a legacy product, a commercial insurance product, an SME insurance, a coverage, higher health coverage, it's emotions. I still will need advice. I will still need someone to tell me what's the right cover, what's the right place to buy it, where to buy it. I still need it. The sale may be more efficient in agency 2.0. The beauty is earlier I would go and meet four people in a day because I have to drive the car, drive the car in KL traffic, park the car, go and meet the customer. Today, just like you and me are talking, Sachi, right now, we talk. Actually, I have all the tools to sell it to you on Zoom now. Many companies, you can get the signature on as we speak. You can activate, do the wholesale. So I'm still physically selling it, but it's not physical. It's virtual physical. It's
Yeah.
what we call phygital. Some people call it phygital, right? That's what it is.
Yeah.
So and the agents can be much more. They don't need to park the car. They don't need to drive the car. So they could probably do 12 meetings in a day, 15 meetings in a day. And this is why we also tell many of the agents, think of digital or direct to consumer, because the low involvement products, you can still tell your customers, don't go to some other website. Here's my link. You go online, you buy. If you don't want to buy from me physically, just go online and buy. But for the ones that require advice, I will still give you the advice.
Okay. Just out of curiosity, and I don't know whether you can share this, right? Today, TunePro is a B2C platform. Retail consumers buy directly from TunePro. Given what you've mentioned about the evolution of the agency model, do you plan to start providing solutions for agents
We
to
do
sell?
have a small uh, we do have agency and this intermediary business as well who sell digitally today for us. In fact, some of the partners who are leading digital players in Malaysia, they are our agents as well.
I see. Okay, very very interesting. Because I've not heard you mention that previously to my knowledge. So that's good to know.
I actually don't think any one model can survive on its own, because I
Okay.
do believe that it has to be multi-channel. Although for us it's very clear where we want to specialize, but it has to be multi-channel.
Okay. Uh, okay, good to know. Good to know. Maybe I've taken up enough air, Terrence. Over to you, Terrence.
Yeah. Yeah. Thank you. Thank you. Earlier, Rohit, you mentioned about how you integrate together with AirAsia and the Big Pay, and how you can access the customers' flight data to reimburse them if there's any delays or cancellations. And I think that's one question from the floor who's actually asking about this topic. And it's a two-part question. So this is the first part. And Lee WK asks, to what extent does the association between TunePro and AirAsia impact the company's brand image and overall business strategy? And here's the
Um,
second.
I actually view it. I actually view it very positively. Where else do you get access to 75 million customers? Where do 70% of Malaysians travel in? Where do what 40, 50% of Thai travel in? 20,000 employees. It's a rock star of a brand, if you ask me. Yes, COVID has given it challenges. It's not a government airline that there was a huge 4 billion, $8 billion bailout package that most of these government insurers in many countries got. They didn't have it. I don't represent AirAsia. This is purely as just as a person. I'm saying that's my view. They're a very important partner and an investor. Today, AirAsia owns 13.5%, 3.5% of my company, um, through AirAsia Digital, as they call it. They are also less than 5% of my sales. Um, Pre-COVID, they were about 90% of 33%, so they were about 25% of my sales. Today, they are less than 5% of my sales. So obviously, there's an upside there. But I think many times people misunderstand it. People think, oh, actually, your lower percentage is just because AirAsia wasn't flying. Actually, that's partly true, but partly not true. Why? Because last year was my highest top line ever. So it's 5% of a much higher base versus 25% of a much lower base. So actually, we've kind of found so many other partners. We today work with 6 airline partners, and with AirAsia now coming back with a vengeance, which we are already seeing in the first few months. I think obviously that percentage is going to go up, and that's hopefully going to be a additional over a period of time. From our perspective, with AirAsia, subject to all privacy, reasons, etc. Obviously, this gives us access to a large customer base to try to test, products, offerings, etc. But we are also run completely independently. We have an independent board, an independent chairman. Yes, we have AirAsia, Irene Omar from AirAsia Digital on the board. Um, but it's completely run independently as an organization. But I don't see it negatively. Yes, short term they've had some challenges, but I definitely view this very positively. And
Okay.
I think the fact that Tune Protect had a distribution partnership with AirAsia was definitely one of the key reasons for me to join this company, because it's important to have a basic access to a customer base for a digital company to survive and to thrive. Most digital companies who fail, the first thing they'll tell you is, I didn't have a captive base to work off. We have it. Why would you want to say it's negative?
Okay. So I hope that answers your question, Lee WK. I, as Rohit mentioned, it's a very beneficial relationship. So just because look at things objectively, lah. Yeah. All right. While we're on the topic of partnerships, I understand you've shown how your partnerships have grown a lot, especially in recent times. Um, can I say that we are expecting continued strong growth in your partnership agreements with all the other players in this space?
For sure. For sure. But with partnership, as I've also been educating the market, there's always cycle. Um, Generally, Ramzan month is not a good month for sales, but it's seasonal. It's okay. Last year was May. This year is April. It's just life because people don't travel typically in Middle East during that month. You have cyclicity in sales. There's with partnerships, generally we take between 3 to 9 months to really get them to what we call a steady state, where I can see a certain run rate happening, where I can look at the dashboard and say, okay, this makes all sense, now it's more stable. It takes 3 to 9 months. There are a few reasons for it. Tech is one of the reasons, but more importantly, it's also culture, getting the right fit, the product fit, the consumer awareness, the knowledge, so on and so forth. So definitely, digital partnership is a vital part of our business.
Okay. And on this topic of partnerships too, there's another question from Isabel Chen. And
Hmm.
she asks, there's a news that TunePro Tech worked with the Inside Food Tech Group to launch an integrated cafe with insurance. May I know how does that partnership work?
Oh wow, okay. It's literally been what, 2 weeks since we launched it. Actually, the concept is not so much a sales concept. Yeah, it's slightly different. It's more what we call a service concept. We're trialing what's called a lifestyle branch. It's an idea from the CEO of a Malaysian business, Jubin. He wants to kind of sponsor this, and he feels it's a big idea. um, Definitely we feel there's legs. The lifestyle branch concept is basically one where it's an insurance branch which actually has a cafe, Hope Cafe, and Egg Dictate. um, so two people there. We also are going to provide, you know, advanced customer experience to Gen Z and millennial customer who don't want to deal with us online. They still want to walk in, but we give them that experience of you can walk in, you know, have a coffee, eat your food, talk to us, or you want to do some servicing at our branch. It's a completely open concept. Just walk into our branch, you will see it. Our probably our regional manager who takes care of KL is probably sitting next to you in one of the chairs over there. That's how it is. Anyway, if you walk into our KL office today, it's going to be the same. I don't have an office myself. I sit anywhere, uh, wherever I find a space in the company. Um, it's really for us a test where we want to see if we can bring in more Gen Z and millennials. We're also setting up a concept of customer panel where we want to set up a panel of customer to whom we will keep going back to ask them, how our initiatives are coming through, what is their perception, are they seeing the right evolution, what are the challenges they face. So I think a branch like this gives us that opportunity to test this model. This is a test. Will I expand it to other branches? We really have to see what the take up rate is.
Okay, understood. So Isabel, I hope that answers your question. Yeah, so maybe Sachi, back to you if you have any
One
other.
of our board members is Dr. Grace from Aon. As you know, she's our audit chairman as well. And she tells me the footfall in Aon is back with a vengeance, right? So obviously it gives us some insights on maybe people will walk into our branch to have a coffee and, eat some food and talk to our staff, and you never know. So that's
Yeah,
really the.
I can say for sure that the shopping malls have been very, very crowded recently. Uh, yeah, so people still like to, I think, have the human touch lah. So
100% I agree. And
yeah.
this morning I was on Breakfast Grill, and I've done my two previous grills with Shouning virtually. And my head of brand and comms was telling me, I thought you really did well today. I don't know if she meant I did badly the last time, but I actually told her I think it is because I physically was there. I think it makes a big difference. Just being in present in front, makes it more personal. You're a
Yes,
lot more relaxed.
yes, yes.
Virtually, you're a bit disturbed. Suddenly, some message comes, your head goes off, you're lost. You can't do that in actually a face-to-face interview. So I'm a big believer in digital. I do everything online, but at the same time, I also believe in the value of actually meeting people in flesh and blood. So
Yep. Okay. Uh, Over to you, Sachin.
All right, thanks, Terence. Rohit, just staying on the topic of partnerships, right? So, like Terence mentioned, you guys have onboarded quite a few partners recently. So, just out of curiosity, or rather, let me frame the question a bit, right? So, from my understanding, distribution in the offline space, the legacy agency space, tends to be very expensive because a significant share of the premiums go to the agents in commissions. So, via all these partnerships that you've built over the past, I think 18 to 24 months, especially, you guys have ramped up a lot. What do the economics of those partnerships look like, just so that the investors can have a feel of what this could potentially mean for the business in the longer run?
I think the difference here is the product mix. I can drive products which I want to drive. I can always choose not to give products I don't want to give. But in traditional distribution models, you don't have that choice. You have to offer the whole plate. You can't just offer. I'm not gonna. You can't just say I'm not going to offer you the rice and the curry. I'm just going to offer you the papadam and the you can't say that. But in our case, we can say I'm a papadam specialist. I'm giving you none of it. I give you a papadam. So a lot of our partnerships sell travel. A lot of our partnerships sell motorcycle. A lot of our partnerships sell PA, which is very profitable. Um, so obviously there's a distribution cost, but I also the benefit you have is this a digital customer, which means the cost of servicing the customer is much cheaper, and the potential to upsell cross sell is much better. Which is why if when you look at our quarterly dashboard, we always give the market a dashboard which says how many customers did I acquire in the last quarter, how much product per customer, how long did they stay with me. These are key KPIs I measure. You look at last year, in Q1, I had 1 million new customers, unique customers. In Q4, I had 1.9 million unique customers.
Okay, cool. Thanks for that, Rohit. Actually, you mentioned so digital makes it easier to upsell, cross sell. Just to make it easier and more relatable for the audience, do you mind just giving us a specific example, if you can, about one of these potential partnerships and how that journey actually looks like, or how that evolution happens?
Sure. So, what happens, for example, with many of the partners, you typically will start with what we call a what we call an entry product. Typically, entry products are health or motor. Once you enter, then you're able to upsell PA, you're able to upsell travel, cross sell travel, you're able to cross sell CI, other products. For example, with a partner like MXM, on their digital MediSaver platform, we started with PA last year. We now sell motorcycle. We also sell other products. So that's the whole idea. You build a relationship, you go in, you make the customer comfortable, and then you're able to offer them a lot more products.
Okay, got it. And so I've been hearing a lot about this concept of embedded insurance. Is
Yes.
this actually embedded insurance in action?
Okay. Embedded insurance is slightly different, right? Embedded insurance is where I embed insurance. So, like when you buy a AirAsia travel ticket, you're getting insurance with it. That's embedding insurance. We have a partnership with Tech. You must have heard about it. You know, today,
Hmm.
if you buy a Samsung phone, if you buy a device protection, hey, it's actually Tune Protect. Many people don't realize it's a small byline somewhere below. And that's what we announced as well to the market. Even a few others like DG, Maxis, etc. It's actually underwritten by Tune Protect. Um,
Ah,
for me, that's embedded insurance. When you have a main product, when we cover the product, you're
hmm.
traveling, you buy travel insurance. You bought a mobile phone, you protect a mobile phone. You bought a product, very soon you will see us in a large retail outlet where if you buy home stuff, we will insure the home stuff. That for me is embedded insurance.
Okay, all right, got it. So just shifting gears a little bit, there's actually this question from Danny Wong, uh, asking about whether you are planning to launch pet insurance. Terence, do you mind just bringing that question up? So just on the vein of launching new products where there's
Oh,
opportunities.
absolutely.
Yeah.
Danny, this is a great question because we've been talking about this for some time in June. We do have pet travel in Middle East. I was surprised to know that 880,000 pets travel annually in Middle East. So we saw a business case and we launched pet travel. And apparently there are families who travel with multiple cats. We also get some weird requests from time to time, including can you cover falcons? But that's a different debate altogether. I'm not sure I'm going to cover falcons. Um, but we do have pet travel. If there's a business case in this part of the world, it's a product available with us, and we can, launch it at no this thing. Pet health, it's in the work. I think most likely Middle East will go first with our concept of ICI do I build. I think Middle East will be launching it first, followed by the other countries. But with pet, I'm very clear that I don't see an opportunity for it to be sold individually online. It will be more led by digital partnerships. So if we find sizable digital partners who can sell pet insurance, we can go quite quickly.
Okay, thanks for that, Rohit. Terence, any more questions along a similar vein?
Yes, actually, two questions came up just as Rohit was talking about it, from our latte journey as well. This person asked, for the partnerships, are they using your tech platform? And will there be any conflicts of interest?
I think there are two different questions. Let me answer the questions one by one. Not necessary. They could use their own platform. So, in the case of Bolt Tech, there's a very little part of our platform that we are using. They use their own platform. Um, when we work with Cover Genius tends to use their own platform. But when we work with AirAsia, or we work with Bamboo Airways, or we work with many of the Middle East partnerships, they use our platform. We are not fixated. There could be partnerships where we give the tech and the insurance and the reinsurance. There could be partnerships where it's just insurance, reinsurance. There could be partnership where it's just reinsurance. And now we have a new model where there's only tech. So we are quite indifferent to it from that perspective. Ideally, we like relationships where the tech platform is offered because that gives us the stickiness. When there's no tech, we are pretty much in an open market. Um, there's no, it's what we call an open relationship. There's no commitment here. Um, and for us, the differentiator is the minute you go deep on the tech and 1 to 2 years is gone, it's so difficult to plug out. How much ever people say is very difficult to plug out, and that's my differentiation. Why should anybody work with me when there are much bigger reinsurers who are 100,000x my size? My differentiation is, hey, you know what? I give you the tech, I give you the expertise, and I'll get you off the blocks much faster than anyone else. On conflict of interest, that's down to contracts. As far as your contracts are very clear, who owns the customer? So typically, most of our deals, which will basically say two or three things very clearly. One is once the customer, again, it depends from deal to deal. Typically, will say if the customer becomes a Tune Protect customer, you can go back to them. If the customer is not yet a Tune Protect customer, you can't go back to them. Typical partner testing. There are always these one-off deals where they'll say, you have to carve out my base separately in your database. And every time you market to them and you're able to upsell, cross-sell to them, I still have to get a fee, for it being someone I referred to you. But I think those are normal commercial conversations that any partner.
Okay, great. I hope that answers your question. Sachi, any other questions you want to pick up on this topic, or should we, start addressing other topics for now?
So actually, I thought the earlier question was a very nice lead into the topic of the commercialization of the tech platform that you guys are building, right, Rohit? I know that's a very big focus area for you, and it's one of your key KPIs as well that you guys are tracking. So, actually, who are the target customers for this tech the tech solution that you're building? Is it just insurance firms, or are you also selling solutions to non-insurance firms in any
You
way?
can sell it to anyone. If it's a non-insurance firm who wants to activate their um, capability to sell insurance and you want us to help you on it, we can do it as well. We will not do it in Malaysia and Thailand because that's the biggest differentiation in the market. So we're not going to kill our own businesses, which is why we limit it to markets where we don't have a direct license.
Okay. And what does the commercials or the economics look like for the tech side of things? Is it a percentage of commissions sold through the platform, or is it on a per policy basis?
Yeah. So today, it's on a per policy basis. So there's a markup on the actual cost we spend. And so the partner actually has to pay a fixed policy fee for every policy.
Okay, a
And there
fixed
is no
policy.
limit. So if they dial up their number of policies, we earn more.
So then it's a very scalable business for you. I mean,
Yes,
presumably.
yes,
Okay.
absolutely. Which is why we want them to, dial it up even more. Which is why for me, I don't put, actually, my differentiation is I don't put a fixed rate or I don't put a volume commitment because I
Mm.
actually, my tech is just being reused. Which is why today, when I work with, uh, when I work with 2,800 over travel agents in Middle East, and they all use my tech, and now I've launched it in Malaysia and Thailand. It's called a travel B2B platform where travel agents can use my travel tech platform to sell travel insurance, to manage receipting, invoicing of their employees, their staff, etc. We created this proposition because we found travel agents having two big issues. One is they had to go outside their system and buy this. Second, they have so many downstream issues in managing their staff. Who sold travel insurance? Who should we pay the commission, performance fee, blah blah blah. And we created a specific tech. And the beauty about this tech is, you know what? Whoever you are, come and use it. Because I don't need to make any customization. So even if you sell two policies or you sell 1,000 policies, I don't care. Use it.
Okay, but just help me understand, right? So presumably there will be some kind of manpower commitment or requirements on your end, because you would need to do the integration work to integrate or sell the tech platform. So if you're only selling a handful of policies, like you would need to sell a certain number before you break even. Is
Actually,
that how it works?
you'll be surprised to know there's almost no integration work. They have to do the integration work. We will give them, once the NDA is signed, we will give them the API documents. They have to do the integration. And in fact, we've also set in motion a few, like in Middle East, we have a few what we call panel of e-commerce players who will
Hmm.
help companies who don't know how to do this, um, to actually set up these connections. It's their connection from their side to the API gateway we are giving them. Some people who have the capability, they can do it on their own. What we don't do is we're not going to come and help you on your website. That's your problem, if you're a partner. But the rest, connecting to insurer, making this available to your customer, all that will help. And it's an open API book.
Okay, very interesting. Because at least to my knowledge, very often when there are tech vendors or tech providers like this, the implementation work is one of the line items along the way, right? Until you go live. So okay, very interesting model, and that means beyond the partnership rep that you have negotiating the partnership and or the commercials, there's actually no additional resource on your side to go live.
There is obviously servicing when some complaints come, etc. But I can tell you we have literally three people servicing this whole thing.
Sorry, three
Wow.
people servicing 2,400 odd.
More than that. More than that. Yeah, we're talking 2,800
Wow.
travel agents plus plus. Yeah.
Oh
So,
wow. Okay, talk about a scalable business.
Yeah. Wow.
Okay.
which is what
Uh,
we have now copied and launched in Malaysia in January, or was it December, and in Thailand in February. Um, I must be honest that we are facing the usual teething issues the first 2 3 months of launching anything new. Even though it's copying and launching, you still have oops, I missed this, oops, I missed that kind of moment. But I think it's starting to stabilize a lot more in Malaysia. Thailand's literally off the oven as we speak, right? Late February, sorry, March. So I think Thailand's not stabilized yet. Malaysia is a lot more stabilized. We will be launching this subsequently in Vietnam, Cambodia, and Indonesia in the next 12 months.
okay. That's good to hear. Um, and just a question off the top of my head linked to this, right? I recall reading that you've recently launched a separate entity, white label, if I understand correctly.
Yeah, yeah.
Um, just out of curiosity, why spin off the commercialization business instead of just leaving it in house?
Um, Two things to it. Okay, why? Okay, we built the tech and we see people wanting it. So nothing wrong. It's highly scalable. It's a product business. It's not a service business. So there's very limited work involved on my side. It's a product business. It's for travel agents. It's for insurers or partners who want to sell bite-sized insurance. I can give them an API, a product configurator. We call it insurance in a box. Um, why did I spin it? Why is it a separate business? A, we did find some resistance when we say tune protect technology, because sometimes insurers are not comfortable working with another insurer's technology,
Yeah.
which is why we literally call it white label. White label. I think it was a very uncreative name, but it is what it is. It's literally what it is. We've had this argument. We have this argument even now from the board, saying, "Why do you want another brand?" And we say it's a B2B brand. I'm investing zero ringgit on brand building. It's purely a word of mouth business. I have hired my first pre-sale staff recently. So far, it's pretty much been running off relationships.
Okay. And just out of curiosity as well, right? How uh, in the future do you plan to segment out the revenues that you derive from the tech business? Because right
Yes,
now, I mean,
100%. Next year I will do it. End of this year. So next year I will be reporting it separately. It's quite small now, as you know.
mm,
It's about 6 million in revenue, but we will start separating it out.
yeah, I mean, just sharing from my perspective as someone who's been following the company, this is one of the reasons why I'm a bit excited about TunePro. So I'm very curious to see how this business will be trending and evolving over time, right? So yeah. Oh,
Absolutely, and I think in Prashanta we have the right guy. 20 years in telco, so none of the tiredness of working for an insurance company. So obviously, it's quite different.
okay. Thanks a lot. Terence, over to you.
All right. Thank you. Yeah. So taking some questions from the audience, and I think it's a pretty interesting question as well from this person. This our latte journey is very interested in your company, Rohit. Yeah. So he asked, is it right to say that when there's a lot of new policies, on the way that profit is recognized, it will actually be a negative impact first? And I think you already addressed it a little bit during the beginning session, but maybe
Actually, it's not a straightforward answer. Our latte journey. It depends on what business. If this is travel, it might not be negative because travel policies are 3 days. You're done. Boom, it's gone. If it's motor, for sure, it'll be negative. If it's PA, likely to be negative too. So it also depends on the type of business you're acquiring, and the mix you are having. But you are not wrong in saying that significant high growth would have some negative impact, but that need not be a loss. because as I said, it also depends on the type of product.
Okay, great. And speaking on the recognition, I think a lot of investors, myself included, are eagerly watching your top and bottom line every quarter. And I know you mentioned that you shouldn't look at it on quarter-to-quarter basis, but given that there's a lot of volatility from the quarter-to-quarter based on the investment assets, um, what should I, as an investor, pay closer attention to
I
when
think you
looking at
will
that?
get a lot more stability on that one. You could argue that I have decided to give up the upside of a higher risk strategy, which is why we've exited a significant portion of equity. As you know, when I came in, there are many things that have gone right. There are some things that have not gone right. It's one of my strategies which didn't work. When I joined, I talked about needing to sweat my investments a bit more. Of course, approved by the investment committee board, etc. But definitely the decision rests with me. So we decided to have 10% in equity. Um, so we invested in China and Asia Pac, and you know what happened to the equity markets. So obviously that didn't go well, and I think we just took a call that it's probably not fair to the company or to the investors to leave it at the mercy of risk when we are not an investment company, we're an insurance company. So what we have done is two things. One, we've exited most of our equity. We are left with only 2% equity, but that would also be exited subsequently. Um, we have significantly reduced the tenure of our bond holding from 4.2 to 2.7 years. We have also, for our Malaysian business, converted most of our bonds into money market funds. So, what you can expect is not crazy returns, but steady state returns. So, hopefully, you don't have the great volatility that we had in the past. But hey, you know what? 3 years, 2 years before the last 2 years, 3 years, for 3 years continuous, Tune Product made a lot of money on investments from the same bond portfolio. Yes, last year was really bad in the first 9 months from the bond perspective, but it has come back, as you know, in the last few months. Um, but having said that, we've gone in for a much more conservative and pragmatic strategy.
Okay, thank you for answering, Rohit. And I think while you're answering, you already answered this question that just came up. So yeah, I believe you've already answered this, and it also at the same time, there's another question that you partially answered, but he's asking whether there's any certain guidelines,
Yes,
or
there
is
is.
it
Yes, there is. Of course, there is certain guidelines on how much percentage exposure you can have to higher risk investments. It's driven by BNM, but it's also driven by your own investment and risk policy.
okay? Great. All right.
There was a
Let's.
question upfront on whether there's a fixed ratio for reinsurance from BNM. Actually, there's no reinsure percentage. Maybe I confused the listener. Commission is fixed by BNM. Reinsurance percentage is not determined by BNM. It's based on the insurance company's assessment of what level of risk we are comfortable taking. So BNM does not prescribe it. Of course, BNM will do their assessments annually of every company, but the sharing ratio is normally agreed between the insurer and the reinsurer, depending on what risk we want to take and what risk they are okay to take.
Okay, great. Yeah, thanks for answering this question as well. Yeah, Sachi, back to you.
Okay, actually, there are just a couple more audience questions. Maybe let's go through those, right? So Li Chin Ang asked about reinsurance and whether there's a what's sorry, I think it's a two-part question. So I think maybe he might have got it confused about reinsurance and retention by the looks of it. But
That's fine.
what's
I
yeah, so
think
I think that just trying to break up the question, right, Rohit? So I think the first part of the question is what is TunePro's typical retention limit, or I think
So it's
retention
not
rate
it's
for
not reinsurance. You're talking about what's the retention we keep. Okay.
yeah. So
Okay.
I think that's the first question, and the second question is whether you have a single reinsurance partner. In fact, I don't know whether you're allowed to publicly talk about it. So I leave it to you if you want to answer.
Okay. So the second question is easy. I can't give you the names, unfortunately. But what I can assure you is we have a strong due diligence and approval process, including board being involved. There has to be a certain credit rating for the reinsurance partner. And we do not have one reinsurance partner, it's allocated across several, depending on what type of reinsurance you're offering. So it's different. On the retention limits for health, today we retain 98%. For lifestyle, we typically retain 88% average. For SME, it's about 67. Overall, the group is at 62, as you saw. For life, it's 50%. Because it's a sandbox company, we typically tend to keep lower in the first few years.
Okay. And so, Rohit, just a question off the top of my head about reinsurance, right? Actually, just out of curiosity, what's in it for the company that's reinsuring you? Because at the end of the day, you as the person who's selling the insurance, you have basically taken on a certain amount of risk, and now you're trying to offload the risk, right? What's the incentive for the reinsurance party to take up that risk?
The profits, obviously, we have a reinsurance rate we have to
Yeah.
pay, and the profits they make from it.
But I would imagine the profits would be pretty thin, right? Because it's basically being sliced up multiple ways.
No, depends. There could be extremely profitable business which I can't keep. I'll give you a very simple example. There are businesses on which there are close to zero claims, but I will still retain nothing. Why? Because if one claim comes, it could be a billion ringgit claim. My company will basically shut down. So in
Okay.
this case, I will retain like literally less than 1%. I'll get a nice reinsurance commission from the reinsurer, and the whole risk will rest with the reinsurer.
I see. So there's also a sharing of the economics back to you when you.
Yes,
I
yes.
see. Oh, okay, that's clear. And I think we've actually knocked off most of the audience questions as we've gone through the session, right, Rohit? I think there's just one more from Andy, or Andy. I'm not sure how to pronounce it. Sorry about that. I think this, Rohit, you've touched on earlier, but maybe he missed out on the slides. If you mind just talking about your
Sure.
combined ratio.
Our combined ratio was at 107%, as we showed earlier. It's continuously trending down, quarter on quarter, and our intention is to bring it below 100% by the end of this year.
Okay. Okay. And I think with that, I'm personally out of questions. Terence, anything on your end?
No, nothing else. I think Rohit has really gone above and beyond answering, all the questions, and not just answering the question, but giving a lot more than just giving a very straight answer. So I'm really appreciative of that. And the more I listen, the more I learn, and the more I think it's very interesting about what Team Protect is doing. So I yeah, I think we can wrap up for tonight. As I see, there's no more audience questions, and mindful of the time that is already 20 past 10.
Yeah.
Yeah, and number of our audience are saying, like, he needs to go already. He can't stay to the end.
But again, I would like to offer, it's a topic that we like, and if your listeners, and I know Sachi, whenever I meet you, you always talk about simplifying, explanations to your people, to the retail customers. If there are questions that they have when they read the annual report, they don't know what is what. Feel free to reach out to our IR team.
Yeah.
Many times we also learn from these conversations. I told a joke in today's BFM. I don't know if you heard it. Why we had to change our tagline. I will leave that to end the night. I actually asked my team to go and do a brand study, and customers told us Tune Protect is Air Asia, Tune Protect is travel insurance, Tune Protect is cheap. These are the three things they told us. So we said, oops, people only know us as a travel insurer. So we need to explain to them we're a lifestyle insurer. We're not just about Air Asia. Air Asia is critical, but we are a lot more than that. And we're not just cheap, we're basically a value for money play. Now, then we said, okay, let's do an unaided brand recall. We closed the Tune Protect name and we just had our tagline, protection made easy. And many people came back and said, is it a condom company? That's when we realized, the word protection means many different things for the common man. Or there was a security agency comment. Somebody thought it's a security agency. So obviously, it means different things to different people, which is why we changed our tagline to Insurance Simplified and said, let's say it. Why are we making it so complex, saying protection made easy, which means security agency for someone and something else for someone else? So coming back, we don't know many things. In fact, we know very little. We don't claim to know all the answers. So absolutely open. If your viewers have questions, they want us to take them through something else again. Happy to come back in and do another one.
Yeah, Rohit, would love to have you back on. And I think definitely for someone like you, very appreciative for you to walk the audience through basically what is basic insurance, right? The basics of how the P&L of an insurance company is, right? Which might be things that people in the industry will be very familiar with, but for the average person on the street, like I mentioned earlier, very, very unintuitive to follow. So really appreciate you doing that. And as always, great to have you on board. Our sessions with you always tend to be, they tend to run really long, but it's partly because you're so open about sharing a lot of these things and going above and beyond asking the questions that are asked, right? So I think without any further ado, and mindful that you also had an early day with the BFM interview, I think let's call it a night. Thank you so much, Rohit, for taking the time to be with us today for almost 2 hours. And Terence, I think with that we can wrap up.
Yes, yeah. So as Sachin mentioned, Rohit, we are very grateful for your willingness and support. And if there's slides will be available for anyone who's interested. So after this session, we'll be uploading the slide, and I believe Tune Protect will also be sharing the slides. So do refer to the slides. You can always refer back to the slides when you're watching the video, or if there's anything that you are unclear of, please do drop us a line, and we will communicate further. And as well as we would like to ask the audience, if you don't mind, to help fill in a little small survey on what you felt about this session. Did you like it? What do you think we could have done better? We'll be very grateful if you can take just a few minutes of your time. It's not a very long survey, and we want to see how we can improve it for our future sessions as well. So thank you so much for tuning in, and I think I wish everybody a good evening, and stay safe, take care, and have a good rest.
All
Thank
right.
you, guys. Bye.
Thank you. Thank you.